Now we can move on to sort of financial planning strategies. There are ways to use your home equity to maximize the efficiency of your overall financial planning goals. So one thing is to do a delay, we call it a bridge to Social Security. So if you take out Social Security when you're 62, then you might get $1,200. Whereas if you wait until you're 70, it could be dramatically bigger, like $3,600, $4,000. So you can go online and you can run through those scenarios yourself to see what the impact to you is. But if we figure out how to use a reverse mortgage to help you bridge to the point where you can wait till you're 70 to get your Social Security, it dramatically increases the amount of monthly income that you'll get going forward. Now, some financial planners don't think that's a good idea, because what if you don't live to be old enough to get that money back? In my humble opinion, you plan to live, you don't plan to die. If you die early, in my humble opinion, nobody's going to care where the money went. Let's plan on living, because the likelihood is you're going to live into your 90s these days. So if we can put off getting Social Security until you're 70, you might get 3 or 4 times as much as if you try to take it at 62. So tax planning is a big option for financial planning with a reverse mortgage. So I have one client who took a reverse mortgage and then uses the reverse mortgage to convert their IRAs from a traditional IRA to a Roth IRA. So that makes all the money that comes from the Roth IRA a not taxed event. And there's lots of reasons why using non-taxed income can be of benefit to you. We all know that the more income you have, the more tax burden you have. So if there are ways to take your money from things that aren't taxed, like a Roth IRA, where the taxes have already been paid, or your home equity in a reverse mortgage, that is not a taxable event when you use equity from your mortgage. So this is a good example. I have a client who's 62 years old, and her husband is 67. So he is retired. She was a stay-at-home mom. So she doesn't qualify for Medicare yet. So he's got 3 years where he's got to pay for health insurance for her before she qualifies for Medicare. Well, health insurance for a 62-year-old person is really high. And so they can go into the exchange and get insurance out of the exchange, but it's very dependent on their income. And so it's important for the next 3 years that they have as little income as possible, so that the amount that they pay for her health insurance is as low as possible. So what they did was they have a Roth IRA, they draw some funds from the Roth IRA, and then they did a reverse mortgage to pay off their current loan, so they didn't have to take money out of retirement assets that would be taxed to pay for their current mortgage. And then when they need a little extra money, they can get that from the line of credit on the reverse mortgage. So all of that is a strategy to help them keep their income low. And not only do they avoid the taxes that would be paid if their income was higher, they also get a much better, dramatically better deal on her health insurance. A lot of people see it as a hedge against reduction in home values, because you're locking in the current equity position in your home, and you are guaranteed a growth rate on your line of credit based on the current interest rate plus 0.5%. So that number is not dependent on what happens to housing prices going forward. So you are kind of buying a life insurance policy or insurance policy on home values to guarantee that you can use the equity in your home to help you in a guaranteed way. So what else could you use a reverse mortgage proceeds for? You could use it for long-term care insurance, or you could use it for a life insurance policy that has a long-term care rider. It can be a nice contingency fund for financial spending shocks. So if something bad happens, you don't have to deplete all of your retirement assets to deal with that particular situation. You have a pot of gold that you can use to deal with an emergency situation. You can also use it to purchase a home. So everybody says they want to downsize, but they don't really want to downsize. They want to have a smaller home, but they want to have the upgraded features, and they want to live in a nice neighborhood. And lots of times they want to move closer to the grandkids, or they want to move to the lake. And oftentimes that's a situation where they might have, say, $400,000 worth of equity, but to get the house they really want, it costs $600,000. Well, they know they can't afford a mortgage payment based on their retirement savings, or they know that a mortgage payment would drain their retirement savings. So a reverse mortgage as a purchase would give you way more buying power and you still wouldn't have to make a mortgage payment. So we did 2 purchases last year, and the people who are the happiest about reverse mortgages are past clients. They are ecstatic that they have a less stressful retirement situation. Some people look at buying a second home, so they'll do a reverse mortgage on their primary and use that to buy the second home at the lake. Use that as the down payment for the second home at the lake. What's the downside of a reverse mortgage? The thing that is the biggest downside is that there are a lot of closing costs associated with a reverse mortgage. You have to pay 2% of the appraised value in a mortgage insurance premium. That money goes into a fund that ensures, if you happen to be the person that lives to 120, that there's enough money when you move out of your home to pay off the reverse mortgage, regardless of how long you live or regardless of what housing prices do. So you make a payment into that insurance policy that allows all of this to work. And that makes the closing costs a little bit high. And now you're not paying that out of your pocket. Basically, you're taking some of your home equity to pay the closing costs for the purposes of securing a reverse mortgage. And so that's the piece you have to take into account when you are making these decisions. Is it worth that decrease in your home equity that is associated with the closing costs in order to secure a reverse mortgage? Let me know if you have questions.